Did you know that adjustable rate mortgages, also known as ARM loans, are starting to make a big comeback? Why is that with mortgage rates so low? And more importantly, is it even a good loan for you to consider? Well, I'll answer those questions in just a minute. Hello, this is David Lykken. Welcome to today's Mortgage Minute, where we promote responsible home ownership through information and education. There are 5 basic elements that comprise an adjustable rate mortgage. There is the index rate, the margin, the note rate, the cap rate, and also the adjustment period. So let's get into those. Index is what drives everything. Usually the index is the Treasury note or a LIBOR, which stands for London Interbank Offering Rate, an European index, or the prime rate. Prime rates are not often used for mortgage loans, more for commercial lending, but it can be there at different times. So those are the basic index rates. Now, you have a margin on top of that. So that can be 1%, 2.5%, 3%, whatever that is. So you have the index rate combined with the margin of 2% or 3%. You combine those two together, and that makes up a note rate. Now, that note rate is fixed for only a certain period of time. There's an adjustment period. So that adjustment period could be every 6 months, 1 year, or 3 years, 5 years. So it depends on how long that adjustment period is and how long you have that initial rate for. Then you have something called a cap, or the rate in which the maximum rate in which you can increase a note rate over what the previous period was. It's, in other words, they cap the maximum rate adjustment. So that is what's also referred to as caps. Now, there's oftentimes something called a teaser rate. When some loans start at a low rate, something less than the index plus the margin, and it's entice people into that ARM loan. It's fixed for whatever initial adjustment period there is, but then oftentimes there's a significant adjustment on that, not to exceed the cap, but it is an adjustment, and that adjustment can be painful. So many people that get these loans need to be informed of what these loans are for and the best purpose of these loans. Yes, you can buy more home typically because of the fully indexed rate is oftentimes lower than a 30-year fixed rate mortgage, but that does not mean that this is a good loan for you. Get a hold of a mortgage professional to advise you on this. It's great being with you. Thank you. See you back here tomorrow.